Hi everybody, this is Thomas Wynn for Wynn Capital with the 2025 second quarter market summary. On the screen is all my contact info, so reach out anytime if you have questions or comments. Before we dive into the summary, let's take a look at the graph of the S&P 500 for the last 12 months, year to date, second quarter, and a little bit of the third quarter. So that's what the graph is on the screen. Going back to the middle of last year, the election moved sideways. Made an all-time high in February. Then we had the decline and the rally. This is the beginning of the year, end of 24, beginning of 25. First quarter, second quarter, and third quarter to the right. Let's take a look at where we went when we were at the lows of the market. The decline from the beginning of the year was about 18%. The decline from the all-time highs, which were in February, about 21%. We got back to even right at the end of the quarter, and that was a 27% rally to get back to even from the previous highs. And now, after today's action, the market has rallied 31 to 32% since the market lows. Okay, let's jump into the quarterly returns for the major categories: the U.S. stocks, developed stocks, emerging markets, global real estate, and the bond market. Very high returns, double-digit returns for the stock categories. These are the averages, so what is that, 2 or 3 times the average in one quarter. Big returns. A little bit of underperformance by the U.S., and I'll address that in a second. This is the first quarter, just beginning of the year to the end of March. The U.S. was negative, if we recall, the first quarter, while the rest of the world was up. There was just people were dumping U.S. stocks and putting their money into foreign stocks. That has mitigated to some degree in the second quarter. We're still trailing by a little bit, but this has led to some outperformance in our portfolios as we are overweighted in U.S. stocks. If we look at longer term, overweighting the U.S. over the 5-year period, 10, 15, and 20-year period has been positive. U.S. returns have been larger than foreign returns for quite a long time, but that may be reversing, and we're probably going to rebalance our portfolios to some degree. So for the 12-month period, the U.S. is catching up, not trailing by as much as it was earlier, just trailing foreign developed for a little bit. But over year to date, which is what you usually the first thing you see on your performance reports, U.S. is 6% versus very large returns for the other categories. As usual, just for the quarter, this is the news. There's not enough room to highlight all the news. It's coming very, very fast and furious. It is a little strange that despite some potentially negative news, the escalation of the war in the Middle East, downgrade of U.S. credit, and rising long-term rates, that lower tax rates in the budget agreement appear to outweigh all of that. So policies, to me, in my opinion, are bad for the country, but they can be good for wealthier investors or investors that have positions in the stock market. A very similar story with a longer, for the last 12 months, middle of last year to the present. Tons and tons of news coming out, lots of strange and unheard of policies, and a lot of uncertainty, but the market's going up. Now we'll just concentrate on U.S. stocks, then look at foreign and emerging markets. Large growth was the big winner after a terrible first quarter with huge declines in tech, the Magnificent Seven, and the market in general. A big bounce back. A couple of them, Apple and Tesla, still have negative returns on the year, but the rest of, in general, large growth did tremendous, and large value was the worst performing, but still positive. And then over the long term, you can see the chart for each class over the longer term. Same thing for international developed stocks like Europe and Japan. Small cap led the way, however, so investors were investing in smaller, more risky companies, and growth came in second, and again, longer term returns down below. And emerging markets also, small cap led the way. The country graph shows that almost all, except for 3 countries, had positive returns. The scale of the returns for the quarter are pretty impressive. The US, we know, had about a 12% return in the quarter, slightly lower than the average for all countries, but many countries had far above average returns, and somewhere just these are very huge returns for a short period of time. Real estate is quite interesting that globally non-US REITs had a huge quarter while the US had a very negative quarter. And in other countries, they're lowering interest rates. Every country is different. Some countries are on the edge of recession, so they're lowering rates. US isn't anywhere near a recession. Rates have remained high. Short-term rates usually fall when we have slow growth, but we don't have slow growth or a poor stock market. So the administration hasn't been able to get the Fed to lower short-term rates. In the meantime, tariffs seem to be driving up long-term rates, and the end result is that REITs had a negative quarter. Commodities, as always, volatile, with a big winner of soybean up 15%, a big loser with natural gas. The majority are losers. And again, if you take a look at the long-term commodities, which 20 years ago I don't think anyone would have thought would have negative price increases over that time, but commodities have done very poorly, with a 5-year period having decent returns, but all other periods having pretty modest to negative returns. The last slide from DFA is dealing with the very sharp rally in gold. People that have owned gold for a long time are finally catching up after long periods of poor performance. My attitude toward gold is it should be part of anybody's diversified portfolio, and it is part of ours. We own all the mining stocks, all the commodity stocks, so when it goes up, it helps us. But I don't believe in speculating or overweighting in gold now, or really at any time. Before we go, I want to take a look at the Case-Shiller 10-year PE ratio. It's one of the most widely followed indicators of where the market is. And in the past, the average PE was around 15%. When it got below that, people tended to buy, and when it got above that, people thought it was a bubble. In modern times, the average has been around this level, about 25%, sometimes below, sometimes far above. So there's been an increase in what is the average PE. When PE ratios get very high, like they did at the tech bubble, corrections follow. But when it was in 95, 96, and I'm a trader on the floor of the exchange, we thought the market was insane. But it went up for for 4 or 5 years after that. So it's not a timing thing. It's just a time to get cautious. And I'm using these tops of the tech bubble, the COVID bubble, and at present we're higher than the COVID PE ratio. And just to review, the P is the price, the E is the earnings. Price times the earnings equals the PE. So a stock that makes $1 is trading at 43. That's the price. Price times earnings. So 43 times earnings is a lot. Like I say, 25 is more reasonable. These very high PEs have led to declines in the past. There's nothing that says this cannot go to the old highs or exceed them. Markets will do what they want. They can have long periods of irrationality. But we tend to get cautious during these periods. Sometimes, some skill and some luck, we're getting a little more cautious and hedging, which we are hedging right now. And it's coincidental with a decline in the market. But for many reasons, it's a good time to be at the lower end of your ranges. Not get out, but be cautious. So that's all I wanted to say about that. But before I leave this slide, I want to be more clear that we have a very large hedge for most accounts that hold equities. And it was partly because of where we are in the market, but mostly we hedge when the price of hedging gets low enough that it can't hurt us if we're wrong, and we hold the hedge. The current hedge lasts until March of next year. So if there is a big decline, anything similar to the decline during the tariff decline, which we did quite well in due to our hedge, will mitigate some of the decline. That is it for now. I hope you find the video helpful, and if you have any questions, please reach out anytime. So long for now. Thanks.